What's up, people? Welcome back to Invest with T-Claus. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Neo, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So we made it through another week of intense volatility. I mean, look at the chart for the S&P 500, down another 1.27% for the week, despite the hurt out there and a major sea of red. Especially if, like me, you're mostly invested in growth stocks, there was one bright spot, and I'm of course talking about ChargePoint. They reported their full 2022 fiscal year this past Tuesday, and the news was good. How good? Good enough to pull an 11.5% move up and manage to maintain to just over 5% of it despite what by all accounts was significant bad news that hit on Friday and dragged the whole market down. So in today's video, I'll hit on some of the relevant highlights from the earnings call, then go over analyst ratings and their stock projections for the year. Along the way, I'll share a bit of perspective on the overall market action from this past week, and finally, what you can reasonably expect moving forward. And yes, there is light at the end of this tunnel. Also worth noting, because ChargePoint does things in a goofy way, fiscal year 2022 is the same as calendar year 2021, and so fiscal year 2023 would be the same as this 2022 calendar year. So keep that in mind. As always, this isn't to be taken as financial advice. I'm not a financial advisor. This is my personal approach to investing and the thought process behind it. I'd recommend watching all the way through so you don't miss out on any pertinent information I'll be sharing. Drop the video an early like if you haven't already, and hit that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. Well, as I was thinking about what to cover and how to kick things off, it occurred to me that I had already dropped some highlights on Twitter right as the call was getting underway. As a reminder, that was quarterly revenue increase of 90% year over year, annual revenue increase of 65% year over year, and the monster forward guidance for this year of between $450 million to potentially as high as $500 million in revenue. To put things into perspective, when ChargePoint originally went public in early 2021, they were projecting sub $350 million for this upcoming fiscal year, and that's something that one of the analysts in attendance also pointed out during the Q&A portion of the call. So again, this is pretty significant guidance departure for the better. Now, instead of reading you the direct answer to the question you're seeing on the screen, the closing statement that Pasquale Romano, ChargePoint CEO, gave to wrap up the earnings call, I think provides a much better insight. And so I quote, "It's been a great journey for everyone in our first year as a public company, again, and on a go-forward basis, exciting times to come. You're really seeing us at the beginning of a very, very, very long multi-decade growth cycle. I can't emphasize that enough. This is not normal circumstances for most markets. For plus or minus 1% penetration, depending on whether you're talking about North America or Europe, into the fleet of vehicles out there, less so for fleets, for consumer passenger cars, plus or minus 1% or so. So a company like this can turn in these results at that level for how early we are in penetration. We have enormous, absolutely enormous expectations for what this looks like in just a very few years." End of quote. When you consider that EVs do not yet represent even 10% of the global passenger and commercial vehicle fleet, but we have undeniably started to transition to a more sustainable electric future, the magnitude of the opportunity starts to come into focus. For North America alone, passenger EV sales are expected to grow at a 41% compound annual growth rate through 2026. As impressive as that sounds, I expect that curve to steepen even more as people start taking a more critical look for alternative to fossil fuels as a result of the ever-increasing cost at the gas pump. Now, keep in mind that Russia represents 10% of the world crude oil supply, and that's not something that you can overcome overnight if things don't pan out here. The other significant point to highlight coming out of the earnings call is the trajectory to profitability they highlighted. You can already see the flattening line for OPEX from Q3 to Q4 while revenue increased. The growth rate alone is impressive, but arguably more impressive is the projected gradual decrease in operating expense as a percentage of revenue. The ratio of operating expense over revenue was 99% in fiscal year 2022, that's 2021 calendar year, but in fiscal year 2023, so this year, that ratio is expected to decrease to 76% and continue going down for future years. And so that ultimately leads to a break-even operating cash flow in the calendar year 2024 or fiscal year 2025, depending on how you're looking at it. That's only 2 years away. So in short, not only are they on track, but their odds of achieving this are only getting exponentially better. Now, you all know I'm bullish, and I'm clearly buying more of the stock while it's down, so there's definitely some bias here. With that in mind, let's see where analysts covering the stock landed post-earning. Bill Peterson from JP Morgan, who was on the call, maintained his buy rating and raised his price target from $20 to $22. David Kelly from Jefferies maintained his buy rating and price target of $28. Well, actually, instead of going through each one individually, let's just look at what our consensus is for the sake of time. We have 10 ratings, 7 buy, 3 hold, 0 sell. The average price target is $25. That's nearly 75% upside from where we are currently if you round up. And on the high end, expectations are that we could go as high as $34. And on the low end, that would be $17. Hitting $17, by the way, would still represent a 15% increase from current level. And make no mistake, we will hit that number in the not so distant future. And why do I believe that? Well, let's switch over to the macro view here for a bit. We've already established that what's pressuring ChargePoint and the rest of the market for that matter is the geopolitical tension, inflation worries, and Fed policy in response to said inflation. So let me bring up the SP 500 weekly chart again and talk through what mostly contributed to the volatility we experienced. The initial move down we're seeing here from Monday to Tuesday is your typical flight to safety and sell before Jay Powell's address. It's so predictable at this point that you can easily trade around it if you're into that. Wednesday morning was confirmation that rate hikes were still happening, but with all the geopolitical tension, economists and analysts alike apparently, finally, had an epiphany that an initial 0.50 percentage point hike just wasn't feasible. Well, you don't say. Just comical at this point. Anyway, anyone who is still trying to spread FUD, so that's fear, uncertainty, and doubt, got egg on their face once Powell took center stage midday in front of Congress and clearly laid out the initial rate increase proposal would be 0.25 percentage point. Take a quick listen.
The thing is, we can't know how large or persistent those effects will be. That simply depends on events to come. So this is where that leaves me. I do think it will be appropriate to raise our target range for the federal funds rate at the March meeting in a couple of weeks, and I'm inclined to propose and support a 25 basis point rate hike. The bottom line is that we will proceed, but we will proceed carefully as we learn more about the implications of the Ukraine war for the economy. We use our tools to support financial stability and macroeconomic stability. We're going to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. So that's how I would think about it.
Doesn't get any clearer than that, right? The next day, the Wall Street Journal printed this fancy low chart here, which basically shows that the expectations around a 0.50 percentage point increase basically got completely squashed. Pretty hard to still make that argument when everyone has now heard it's just not happening. Again, I've been making this argument for the past month and a half, and lo and behold, here we are now. So of course, markets rallied, and that's what you're seeing here. Now, the steep drop that you're seeing here on Friday, that's in response to more geopolitical news from the conflict between Russia and Ukraine, and this nuclear power plant being caught in the crossfire. Thankfully, the worst was avoided here. Now that you're all caught up at a high macro level, let's tie it back to ChargePoint. I've told you before that what markets dislike more than bad news is the lack of clarity and uncertainty that sets in leading up to the potential bad news. We now have clarity on the war breaking out. We also have clarity on the initial amount of the rate increase. And guess what? If you take a quick step back and look at the year-to-date chart for ChargePoint, we hit bottom here on February 24th and are starting to trend back up. It's faint, but it's there. Know who else is showing the same pattern? The SP 500 chart, the Dow Jones chart, and the NASDAQ chart. Now, this isn't to be taken as an absolute. However, most of the bad news is priced in, or just about, in my opinion. And even though it doesn't feel like we're making progress, ChargePoint and others are slowly moving back up, and we are incrementally getting clarity on the macro level. Of course, there's always a chance that something crazy and unforeseen hits us from our blind spot, so one has to remain vigilant in these volatile times. DCA, or dollar cost averaging, is your friend. Ultimately, here's the bottom line. ChargePoint posted stellar results and outstanding forward guidance. It now serves more than 50% of Fortune 500 companies. Its list of in-car integration for automotive OEMs continues to expand with Pininfarina, Porsche, and Audi, just to name a few they picked up since the last time I covered them. Amazon Alexa is another one on the consumer platform side that stands out. The reward outweighs the risk, in my opinion, at these levels, especially for those with a longer investment time horizon. Everything happening on a macro level, in the end, is only creating a more compelling argument for the many benefits associated with gradually diversifying away from fossil fuels, which bodes well, ultimately, again, for ChargePoint. And on that note, I'll leave it here for today. Don't forget to drop a video a like if it helped you gain a new perspective, and share with others who you think could also benefit from it. For my newcomers, subscribe, and don't forget to ring the notification bell so that you too can stay in the know. As a reminder, I post every Sunday, and as time allows, I target one additional in-week video for more crypto-focused content. Thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.